Two people invest the exact same Feijun 50,000 20 years later. One of them quietly regrets everything. Not because he lost money, but because of what it cost him to make it. At the start, the choice looks obvious. One buys something real, something he can see, touch, and proudly call his own. The other buys nothing you can hold, just a number on a screen. And if you were standing there on day one, you would probably bet on the wrong person without even thinking twice. Jake takes his $50,000 and turns it into a 3-bedroom rental property in a decent neighborhood. It's not flashy, but it's solid. It's the kind of place he can drive past and feel proud of. The kind of asset that feels real. Marcus takes his $50,000 and puts it into a total stock market index fund. No keys, no tenants, no physical presence, just a balance sitting inside a brokerage account. And if you're honest, in that moment, Jake feels like he's winning. Because one of them owns something visible, the other owns patience. Let's break it down because this is where most people get it wrong. Jake uses his $50,000 as a 20% down payment on a $250,000 house. He locks in a 30-year mortgage at 7% with a monthly payment of about $1,130. Soon after, he finds a tenant willing to pay $100 to $800 a month. On paper, that's $470 in monthly profit. It feels simple, predictable, almost effortless. Marcus, on the other hand, invests his $50,000 into index funds and sets up an automatic contribution of $300 a month. Then he does something that feels completely wrong. He ignores it. In the first year, Jake is energized. Rent checks arrive like clockwork. Every payment feels like validation. He talks about his property like it's a business, like he's building something meaningful. Marcus logs into his account every now and then, watches the balance go up a little, down a little, and logs out. Nothing exciting, nothing worth talking about. By year 2, Jake still feels ahead. Marcus still feels invisible. No one asks about index funds over dinner. No one is impressed by consistency. But here's where things quietly start to shift. After 3 years, Jake has collected around $64,800 in rent. That sounds impressive until reality shows up. Property taxes, insurance, repairs, vacancy, a broken water heater, a leaking roof. A month with no tenant, that $470 monthly profit starts shrinking fast. After everything is accounted for, Jake's actual cash flow over 3 years might only be $2,000 to $4,000 total. Not per year, total. And that doesn't include his time late-night calls, weekend fixes, constant attention. Marcus, meanwhile, has invested his $50,000 and added $300 every month. His account is now around $75,000. He spent 0 hours managing it. No calls, no emergencies, no interruptions. But here's the part people love to point out. Jake still has one powerful advantage: leverage. He used $50,000 to control a $250,000 asset. As the property increases in value, so does his equity. After 3 years, the house might be worth $270,000 or more. That increase didn't come just from his money, it came from borrowed money. And that's what makes real estate so powerful. Now fast forward to year 5, Jake has seen more reality, more repairs, more tenant turnover, higher taxes, higher insurance, maybe a major expense like a roof replacement. His rent has increased, but so have his costs. After everything, his real return sits somewhere around 3% to 5%. Not terrible, but not the effortless win it once looked like. Marcus, on the other hand, is still doing the same thing. Nothing, but now something important is happening. His portfolio isn't just growing, it's accelerating. Compounding has kicked in. The gains are now creating more gains. And that slow, boring line is starting to curve upward. By year 10, things get serious. Jake's property might now be worth around $340,000. His mortgage has gone down, and his equity is sitting at roughly $170,000 or more. That's real wealth. But it came with time, effort, responsibility, and risk. Marcus has also stayed consistent. He invested his $50,000 and kept adding $300 every month. His portfolio is now sitting in a similar range around $170,000. Almost the same outcome, but the experience couldn't be more different. Jake worked for his returns. Marcus waited for his. And this is where the gap can quietly explode, because small changes start to matter more than anything else. If Marcus increases his monthly contribution from $300 to $500, everything shifts. Over the next 10 years, that extra $200 doesn't just add up, it compounds. In the stock market, time and consistency multiply every decision. What feels small today becomes massive later. Now jump to year 20. Jake's property is worth somewhere between $450,000 and $500,000. His mortgage is nearly paid off. He owns a real, tangible asset. Over 2 decades, he has collected rent, handled expenses, dealt with problems, and kept everything running. After all of it, his total net profit from cash flow might land somewhere between $40,000 and $80,000. Maybe more in a strong market, maybe less in a difficult one. Marcus's portfolio, meanwhile, has grown to a similar level, possibly higher, if he increased his contributions. And most of that growth didn't come from what he invested, it came from compounding. Now step back and look at the full picture. Both of them built wealth, both made smart decisions, but their lives along the way were completely different. Jake had control, leverage, and something real he could see, but he also had stress, time commitments, and concentrated risk. Marcus had simplicity, diversification, and freedom, but he had to tolerate uncertainty, market drops, and the feeling of doing nothing for years. And this is the part most people miss. Neither path is better. They are just different games with different trade-offs. Real estate can win if you treat it like a business and accept the work that comes with it. Index funds can win if you stay consistent and don't panic when things get volatile. The real mistake isn't choosing real estate, and it isn't choosing the stock market. The real mistake is choosing either one without understanding the full cost, because the numbers people show you are never complete. They show income, but not effort. They show returns, but not stress. They show outcomes, but not the years it took to get there. In the end, this decision has very little to do with money. It has everything to do with how you want to live your life while you're building that money. Do you want control, even if it demands your time? Or do you want freedom, even if it means giving up control? Because both Jake and Marcus made money, but only one of them got the lifestyle he actually wanted while building it. And that's the part no spreadsheet will ever show you. So before you pick a side, don't ask which investment is better. Ask yourself something far more important. What kind of life do you want to build while you're getting there? Both real estate and index funds can build wealth, but they demand very different lifestyles. One trades time, effort, and control for returns, while the other trades control for simplicity and freedom. In the end, the best investment isn't about money, it's about the life you want while earning it.